Have you ever had the market do that thing where it waits for the exact moment you feel confident, and then humiliates you? Like you finally decide, okay, I'm doing it. I'm buying, and within hours the price acts like it was personally offended by your optimism. You buy the new phone, and the next day it's $200 cheaper. You buy the plane tickets, and the next week there's a flash sale. You finally stop overthinking and make a decision, and reality immediately punishes you for it. Now imagine that feeling, but instead of a phone or a flight, it's your entire investment thesis. You didn't gamble. You didn't chase a meme coin. You didn't click a sketchy link on Twitter. You bought Bitcoin because you believed the fundamentals. You read the reports. You listened to the macro arguments. You saw the institutional wave coming. The ETFs were here. Big money was supposedly stepping in. Everyone kept repeating the same narrative, this time is different. This time institutions are involved. And maybe you bought at $95,000. Maybe you bought at $100,000. Maybe you bought at $104,000 in November 2024 thinking, finally. This is the moment the world catches up. And then instead of a clean continuation to $150,000 or $200,000, you watched Bitcoin chop, stall, and whip around between $85,000 and $98,000 like it's stuck in a washing machine. And now you're asking the question that quietly drives people insane, if ETFs are here, and adoption is real, and the scarcity argument didn't magically become fake overnight, why doesn't the price reflect it? Where is the inevitable institutional bid? Why does it feel like the market is ignoring what should be the most bullish catalyst in Bitcoin's history? Are we missing something obvious? Or worse, is the market playing a game most people don't even know exists? My name is Sam, and I spend an unreasonable amount of time thinking about why assets don't behave the way they're supposed to. And if you're someone who believes in Bitcoin long-term, but you're watching the price action and thinking, this makes no sense, then I want you to lean in, because what I'm about to explain isn't a conspiracy theory, it's the part of modern finance people avoid talking about because it sounds too uncomfortable. You can pressure an asset without breaking any laws, without hacking anything, without some smoky room full of villains. You can do it with incentives. You can do it with structure. You can do it by exploiting weakness in the plumbing. And if you understand the plumbing, suddenly the price behavior stops looking random and starts looking like something else entirely, a stress test, a shakeout, a transfer. And I know what you're thinking already. Sam, are you about to tell me banks are manipulating Bitcoin? Because that phrase gets thrown around so much it's basically a meme. It lives next to blurry charts and late-night tweets and people typing in all caps. And I used to hate that narrative too, because it felt like an excuse people use when they buy the top. But then I started digging into how price suppression can happen in perfectly legal ways. Not by controlling Bitcoin itself, but by controlling the pressure points around it. And the deeper I went, the more I realized, you don't have to manipulate Bitcoin directly to influence Bitcoin's market behavior. You just have to understand where forced selling could come from, where leverage lives, where margin meets reality, and where one big entity could become a source of systemic stress. Because markets don't move on beliefs. Markets move on flows. Who must buy? Who must sell? Who is forced? Who can wait? That's the real chessboard. And today I want to show you a pattern that keeps repeating across history, the debt spiral. It's not just something that happens to countries. It happens to companies. It happens to households. And when it happens, assets get sold at the worst possible time, not because the owner wants to sell, but because the structure demands it. And here's why that matters for Bitcoin: if you can create a forced seller, you can create temporary suppression. If you can create temporary suppression, you can accumulate cheaper. And if you can accumulate cheaper, you can win without ever breaking Bitcoin. So let me start with something that sounds completely unrelated, because this is where most people roll their eyes and then, 10 minutes later, go, wait, hold on. Back in the early 1980s, Mexico borrowed billions of dollars from international banks. The pitch was simple: fund infrastructure, fuel growth, modernize the economy. It sounded smart. It was framed as progress. But there was one detail that turned smart into trap: the debt was denominated in US dollars, not Mexican pesos. And if you don't immediately see why that's lethal, here's the key: Mexico doesn't control dollars. Mexico can't print dollars. Mexico can't magically create the currency it owes. It can only earn dollars through exports or borrow more dollars. So when the US Federal Reserve raised interest rates to fight inflation, the dollar strengthened, Mexico's payments exploded, and suddenly Mexico was stuck owing massive amounts of money in a currency it couldn't control. It's like being told you have to pay your rent in a foreign currency that you're not allowed to access unless someone approves it. Now imagine that foreign currency surges in value. Your rent just doubled, not because you did anything wrong, but because the environment changed. Mexico fell into a crisis and the IMF stepped in with what they called a rescue package. But the rescue came with conditions: privatize state companies, cut social spending, open markets, sell assets, restructure the country to satisfy creditors. This happened in Mexico, in Argentina, in Brazil, in Indonesia, and dozens more. It's not a one-off story. It's a repeating mechanism. And the mechanism is psychologically brutal because it doesn't feel like a robbery. It feels like you're being responsible while your options shrink. You borrow to grow. Conditions shift. Debt becomes heavier. You need help. Help comes with demands. You sell what you didn't want to sell. You lose sovereignty, slowly, through paperwork. That's what a debt spiral is. And you might be thinking, okay Sam, what does Mexico in 1982 have to do with Bitcoin in 2026? Everything, because the core lesson is universal: when you owe obligations you can't easily meet, and you don't control the variables that determine the cost of those obligations, you become vulnerable to pressure. And pressure creates forced decisions. Forced decisions create forced selling. Forced selling creates price drops. And price drops are where winners accumulate. Now let's bring it down to something you can feel. Imagine you own a $500,000 house. You've got equity, you've got pride, you've got that sense of security. Then you take out a $100,000 home equity line of credit at a variable interest rate. At first, rates are low. Payments are manageable. You're paying $400 a month. You feel smart. You feel like you used your assets. Then rates rise. Your payment becomes $800. Then $1,000. Then $1,200. But your income didn't rise. Now what? You can refinance, if you qualify. You can sell, but maybe the market is down. Or you can default, and lose the house. Here's the part people don't talk about: the psychological trap starts long before default. The moment you feel the squeeze, you start making fear-based decisions. You cut corners. You sell things you didn't want to sell. You accept worse terms just to buy time. And the lender doesn't have to do anything illegal. They just sit there knowing the structure has you by the throat. That's pressure without crime. That's the kind of financial warfare that doesn't require villains, only incentives. Now scale that up to corporate finance. Instead of a house, picture tens of billions of dollars in Bitcoin. Instead of a HELOC, picture layers of debt instruments, convertibles, preferred shares, interest payments, dividends, refinancing windows, and a stock price that determines whether the whole machine stays alive. This is where we need to talk about the elephant in the room: MicroStrategy. And before you say, "Oh, I'm not invested in MicroStrategy," you still need to understand this, because MicroStrategy is not just a company holding Bitcoin. It's a structure holding Bitcoin. And structures can become forced sellers. And forced sellers create waves. On paper, MicroStrategy is a software company. In reality, it has become something closer to a leveraged Bitcoin acquisition vehicle that happens to be publicly traded. The playbook is simple: raise money through equity issuance, convertible bonds, preferred shares, then use the proceeds to buy Bitcoin. It's a flywheel. When the flywheel is spinning, it looks genius. The company buys Bitcoin, Bitcoin rises, the stock rises, the company can raise more money, buy more Bitcoin, and the cycle reinforces itself. In boom conditions, it feels unstoppable. But here's what most retail investors underestimate: when you turn a company into a leveraged Bitcoin proxy, you also turn it into a stress point that can be attacked, tested, and pressured through normal market behavior. Not because someone hates Bitcoin, but because if you're a fund looking for asymmetric opportunity, these structures scream, "Trade me." And the key concept here is something boring that secretly runs the whole story: premium versus discount to net asset value. Net asset value means, what are the assets worth, minus the liabilities? In MicroStrategy's case, the dominant asset is Bitcoin. So if MicroStrategy holds a mountain of Bitcoin and has debt obligations, you can roughly estimate what the Bitcoin stash is worth and what the debt subtracts from that. If the market values the company above that net value, it's trading at a premium. That premium is oxygen. Why? Because when the stock trades at a premium, MicroStrategy can issue shares and raise capital without the market treating it like a desperate fire sale. Investors buy the stock because they believe the company will keep accumulating Bitcoin and that Bitcoin will go up. But what happens if the premium disappears? What happens if the market says, "We're not paying extra for your wrapper"? If the stock trades at a discount, issuing equity becomes like selling Bitcoin at a loss. You're basically handing out claims on Bitcoin cheaper than the Bitcoin itself. So you stop issuing shares, or you hesitate, because you're destroying shareholder value. Meanwhile, obligations don't stop. Interest doesn't stop. Dividend commitments don't stop. And this is where the debt spiral logic starts creeping in. Because if you can't raise capital easily, you rely on cash reserves. And cash reserves are finite. And the market knows that. Markets price countdown clocks. If there's a known window where cash could run low, even if it's months away, traders start positioning. People start testing the structure. And a structure that depends on confidence becomes vulnerable to a confidence attack. Again, not illegal. Just pressure. Now let's outline the reflexive loop, because this is where it gets scary. If MicroStrategy's stock loses its premium and starts drifting toward discount territory, capital raising becomes harder. If capital raising becomes harder, the company relies more on cash. If cash drains, perceived distress rises. If perceived distress rises, the stock can drop further. And if the company ever needs liquidity and can't raise it through equity at reasonable terms, it may have to sell assets. What asset? Bitcoin. If MicroStrategy sells Bitcoin, even partially, it adds selling pressure to the broader market. Bitcoin drops. If Bitcoin drops, MicroStrategy's Bitcoin stash is worth less, which can drag the stock down even more. If the stock drops more, raising capital becomes even harder. And the loop tightens. That's a death spiral. Not because the technology failed. Not because Bitcoin is broken. But because leverage structures can implode when the environment isn't friendly. So the obvious next question is, why would anyone want to push it into that loop? And this is where people get emotional and start yelling, manipulation, but I want you to stay calm and think like a strategist. Incentives create behavior. Imagine you're a major investment bank, a large hedge fund, or a capital allocator with institutional clients. Your clients want Bitcoin exposure, but they want it in size, with liquidity, with custody handled, with regulatory compliance. They don't want to be clicking buy on a retail exchange like a teenager. They want institutional pathways. Now ask this, if you could buy Bitcoin in massive size at a discount, would you? Of course you would. The biggest money in the world is obsessed with buying quality assets cheaper. That's the whole job. And how do you buy in massive size at a discount? You wait for forced sellers. Because forced sellers don't negotiate from strength. They negotiate from urgency. If a company ever gets pressured into selling billions worth of Bitcoin, it likely won't dump it in small chunks on open exchanges, it will do block trades, phone calls, negotiated deals, price concessions for size. We need to sell $5 billion. Fine, we'll take it, but we want 10% off. And then what happens? The buyer can distribute it, hold it, lend it, repackage it, or simply accumulate a strategic position cheaper than the public ever gets access to. That's not a conspiracy. That's how large markets work. And to make that scenario possible, you need the seller to be under pressure. You need distress. You need the premium to vanish. You need the countdown clock to matter. And how do traders create or amplify pressure? They short the stock. They publish critical research. They highlight risks. They lean on the weak point. Again, not illegal. And here's where history becomes the most uncomfortable part of this entire discussion. There is precedent for financing structures that legally destroyed companies and transferred wealth from shareholders to sophisticated players. In the early 2000s, certain toxic financing setups, like some pipe deals and certain types of convertible instruments, created incentives where lenders benefited as a stock fell, because the lower the stock went, the more shares they received. Think about that for 1 second. If a lender profits when the stock collapses, then the rational move is to apply pressure and push it down, because the structure itself rewards the decline. It created a legalized predatory dynamic. Companies entered those agreements desperate for cash, and many got crushed. Was every case a criminal conspiracy? No. But the outcomes were still devastating. The lesson is simple: you don't need fraud to create destruction. You need a structure with misaligned incentives and an environment that turns the screws. Now, MicroStrategy's structure is not identical, and I'm not claiming it is. But the psychological rhyme is what matters. If the market believes MicroStrategy could become a forced seller of Bitcoin, then MicroStrategy becomes a target for pressure trades. And pressure trades can spill into Bitcoin because MicroStrategy is one of the largest holders, and the market is obsessed with the possibility of large holders being forced to sell. So now let's address the part everyone really cares about: what do you do with this information? Because I know the emotional reaction. So you're telling me I'm trapped? You're telling me Bitcoin is rigged? No. I'm telling you the opposite. If you understand the game, you stop reacting like prey. The first thing you need to separate in your head is this: MicroStrategy is not Bitcoin. Bitcoin is decentralized. Bitcoin does not have debt obligations. Bitcoin does not owe dividend payments. Bitcoin does not have a management team that can be squeezed by market mechanics. MicroStrategy is a company with a capital structure. If MicroStrategy gets stressed, that does not prove Bitcoin's thesis is wrong. It proves leverage is dangerous in volatile environments. Second, pressure creates opportunity. If sophisticated players want to accumulate Bitcoin, and they want it cheaper, they will happily exploit moments of panic. And that's the most important psychological shift you can make. The worst possible move is to panic sell into manufactured or structurally driven pressure, because that's exactly how wealth transfers from emotional holders to strategic accumulators. If you believe in the long-term thesis, scarcity, decentralization, monetary debasement, the digital hard asset narrative, then volatility and pressure are not reasons to abandon the thesis. They're the cost of admission. Third, time frames matter. Structures like MicroStrategies create windows. Cash reserves, refinancing timelines, maturity schedules, these create countdown clocks. Markets hate countdown clocks because they invite testing behavior. As deadlines approach, volatility tends to increase because traders want to see whether the structure holds or cracks. If the structure holds, if refinancing happens, if capital markets stay open, if Bitcoin rises, then the entire death spiral narrative weakens dramatically. And when narratives break, positioning flips. Shorts cover. Pressure releases. Price can move fast. Now let's make this concrete with a simple thought experiment, because examples are what make this real. Imagine you bought Bitcoin at $100,000. You put in $10,000, so you own 0.1 BTC. Price drops to $92,000. You're down $800. It feels awful. Your brain starts looking for relief. Then you watch a bunch of scary talk online: MicroStrategy risk, forced selling, suppression, institutions manipulating. Now your brain wants to do something, because doing something feels like control. But what if the real edge is not doing something? What if the edge is understanding what kind of drop this is? If the thesis is intact and the drop is structurally driven, then panic selling is basically handing your asset to someone with more patience. Let's say the pressure intensifies and Bitcoin dips to $78,000. Retail panics. Headlines scream. Your friends text you like, "Bro, are you okay?" The emotional move is to sell because you want the pain to stop. But the strategic move, if you truly believe the thesis, is to treat it like discounted inventory. And that's exactly how professional investors think. Retail sees red candles and thinks, "I'm wrong." Pros see red candles and ask, "Why is it red, and did the fundamentals change?" That one question is the difference between getting shaken out and accumulating. That's the psychology behind most wealth transfers in markets. Not scams. Not fraud. Pressure, volatility, emotion. Now here's another historical parallel that makes people uncomfortable: gold. For years, gold was treated like a relic. There were periods where major institutions sold reserves near lows, and later the price multiplied. Were they stupid? Were they pressured? Were they strategically supplying the market? I can't prove motives, and I don't need to. The pattern matters: large sellers create supply, price falls, patient accumulators buy, price recovers, and the people who sold too early look foolish in hindsight. So now you have to ask, if institutions truly believed Bitcoin was worthless, would they spend time building ETFs, creating products, publishing research, trading basis spreads, and engineering complex pathways to accumulate? Or would they ignore it like they ignore worthless assets? You don't engineer complicated games around things you don't value. You engineer games around scarce assets you want more of, but you don't want to pay full price for. So what should you actually do? First, stop treating short-term price as a moral judgment on your intelligence. Bitcoin is volatile. It always has been. The question isn't whether it can drop 20% or 30%. It can. The question is whether the long-term thesis has changed. Second, watch the structural risk indicators instead of doom-scrolling price candles. If you're worried about MicroStrategy as a pressure point, focus on the variables that matter: liquidity, access to capital, refinancing windows, cash burn versus obligations, and whether the company is forced to sell Bitcoin. If there's no evidence of forced selling, then you're mostly dealing with narrative and positioning. Third, size your exposure so you can survive volatility without emotional collapse. If a normal drawdown ruins your sleep, the problem isn't Bitcoin, it's your position sizing. The market's job is to find your emotional breaking point and test it. Don't offer your breaking point on a silver platter. Fourth, educate yourself on market mechanics. Net asset value, leverage, convertibles, short interest, basis trades, these aren't boring details. These are the rules. And the only reliable defense against being outmaneuvered is understanding the rules better than the people applying pressure. Because here's the uncomfortable truth: a lot of retail investors aren't wrong about Bitcoin. They're early. Or they're impatient. Or they're undercapitalized. Or they're emotionally overexposed. And that's where the market eats them alive. So where does that leave us? It leaves us with a calmer, more strategic framing of what you're experiencing. Bitcoin may be in a phase where adoption is real, the thesis is real, but price is being dragged through the traditional finance arena, an arena where leverage, proxy vehicles, and structural pressure points can create temporary suppression and violent chop before continuation. That doesn't guarantee Bitcoin goes to $150,000. Nobody can promise you that. But it does explain why the existence of ETFs and institutional involvement doesn't automatically mean up only. Sometimes institutional involvement means the games get smarter. The tactics get cleaner. The pressure gets more psychological. And if you're sitting there thinking, why does it feel like I bought the moment the market got weird? Maybe you didn't buy at the wrong time. Maybe you bought at the time the market transitioned from simple retail-driven cycles into something more complex, where the big money doesn't just buy, it accumulates strategically, it waits for stress, it exploits weak structures, and it uses volatility like a weapon. So I'll leave you with one question that will reframe everything. When you see chaos, are you looking at a broken asset, or a controlled stress test designed to reveal who has conviction and who doesn't? Because if you still believe in the long-term thesis, a scarce decentralized digital asset in a world where currencies are debased, debts expand, and trust is constantly challenged, then short-term suppression, chop, and volatility aren't reasons to abandon the thesis. They're the environment the thesis must survive to become real. And if you don't believe in that thesis, if you think Bitcoin is purely a speculative bubble, then honestly you probably shouldn't own it, because the volatility, the pressure, the drama, the incentive games, they're not going away. That's the arena. The only way to win in that arena is to understand the mechanics, manage your emotions, and stop letting price action bully you into decisions you'll regret later. If this video helped you understand what might be happening beneath the surface, subscribe for more deep dives like this, because the more you understand the rules, the harder it is for anyone to play you.